pray. Father, we thank you for the gift of life, of health, of wealth, of your provision, and of your protection. We thank you for a morning like this when we can come together to discuss issues that affect our industry and to look at the opportunities that are available that we can take advantage of to make our own system a better one. We thank you that you take your seat in this meeting and that we will come out of this meeting with a lot of profits. Thank you. In Jesus' name we have prayed. Amen. On this note, I want to welcome every one of us into this meeting on behalf of the Governing Council of the National Banking College and the Chartered Institute of Bankers. Welcome to our maiden collaboration in trying to sort out and to serve our stakeholders better. Who are our stakeholders? Our stakeholders are the financial services providers of this nation. Our two institutions are mandated to help build the capacities and understandings and come forward with thoughts, programs for the benefit of our sector and for the growth of our sector. It is in this spirit that these two institutions have come together to host this public dialogue. This morning, we are taking a look at where we are. How have we gotten here? In the last couple of years, it has been one thing after the other globally. So we moved from COVID, we went into the Ukraine-Russian war, which is still raging, and its repercussions on economies across the globe. We are still in those issues. Nations and many nations across the world have been threatened with recession. Out of all of these things, inflation is going high everywhere. Ghana has not been exempt from these things. And for us in Ghana today, we are looking at the domestic debt exchange program. The program that is hoped will significantly contribute to the recovery of our economy and to make things better. But we also know that in the midst of all of this, we do have the financial services sector being really hit. And so we are looking at this program today, and we are looking at the implications for the sector, and we are looking at the advantages or the lessons so far learned. To help us do this, we have two able gentlemen who will be introduced by the panelists. These are very experienced people who are in the center of all of these things and who will be able to do that. But for others' sake, we also do have a moderator. Our moderator is no other person than Mr. Robert Jatu. Robert is currently the CEO of the Chartered Institute of Bankers. Robert comes in with a wealth of experience and knowledge in terms of strategy, in terms of the financial services sector, in terms of the economies and the general public that we serve. And I believe strongly that he's well able to actually steer this whole meeting to a successful end. And so on this note, and without wasting too much time, Robert, you have so many credentials. I am unable to read all of them here, but ladies and gentlemen, just Google Robert and you will be impressed. And so this morning we have a very strong team, and I want to say thank you to all of you for being here. As I hand over to Robert to please start the process. Thank you very much and welcome again.
Thank you so much, Gloria. Please confirm if you can hear me clearly.
We can hear you. I can.
Excellent.
Yes, I can hear you.
So thank you once again. Thank you to our audience who have joined us, and thank you, Gloria. It's been great working with you to put this program together. I think it's very much aligned to our mandate, as you correctly highlighted. The Chartered Institute of Bankers' mandate is to promote banking education and also regulate the practice of banking. And for the National Banking College, you're absolutely right. A center of excellence for research and teaching in banking. So thank you. Thank you to our panelists who have kindly agreed to share perspectives with us today. And thanks to our council members. Certainly I see the president, Mr. Benjamin Benume here, and other council members. So we acknowledge all of you. In the interest of time, I believe we can make progress. And so certainly the purpose of this dialogue is to educate, is to inform, and certainly share perspectives. So that's the spirit within which this has been done. And the topic is quite clear: the future of the banking industry in Ghana, the DDEP lessons so far, which is the domestic so far, and what are the implications. I think it's fair to say, and Gloria rightly said as well, that the banking sector has been the eye of the storm for a number of years now. If you cast your minds back, 2017, 2019, there was banking sector reforms, a resolution of banks, 2020, COVID hit, and here we are, 2022, 2023, domestic debt exchange program. The real question is, what's the next thing around the corner? And how do we continue to thrive as a sector? So it's an important conversation, and we are extremely glad that our panel members, who are very, very accomplished, have decided to share their perspectives. So I have our first panel member, Dr. Philip Abredu-Otu. Philip Abredu-Otu, who is the Director of Research at Bank of Ghana. He's also a member of the Monetary Policy Committee. He's done significant work in the banking sector. He's actually worked in Bank of Ghana for over 29 years. That's as long as you can imagine his contribution to the financial services sector of this country. But he spent 6 of the 29 years with the IMF, 6 years, working on different projects, and certainly very, very accomplished. In the interest of time, Dr. Philip Abredu-Otu, please pardon me if I don't read everything, but certainly your credentials are not in doubt. And one thing that audience can be sure of is that Philip has been neck deep in the conversations and from a regulator's perspective on this debt exchange program. So he's very, very well placed to share perspectives on the subject matter. The next panel member we have is Professor Noel Tego. He describes himself as a public intellectual, and I tend to agree. He's a well sought after consultant in education, in strategy, technology, and many more. Prof is, he's taught in different universities and was a professor at Oxford University, and he's actually based out of Oxford. So Philip and Prof, thank you. Please confirm if you can hear me.
Yes, Robert, we can hear you. I can hear you clearly.
Excellent. Prof?
Robert, I can hear you clearly. Thank you.
Great. Excellent. So the format for our discussion, each panel member will have 5 minutes, if you stretch it, 7 minutes, to share perspective on the lessons so far, but also the implications. But we'll start with the implications, and that Philip would take. But before he comes in, we all are aware of the chronology of this debt exchange program, particularly the domestic debt exchange program, which was launched on the 5th of December, 2022. I think it's important to put on record that there has been a number of amendments to it, and there have been several deadlines, so at least 5 deadlines. So on the 5th of December, when it was launched, the deadline was 19th of December 2022. That deadline got shifted to 30th December 2022. A third deadline was 16th January 2023. Then it went to 31st January 2023. Then to 7th February 2023. I think where we are now is government has announced that we've achieved 85% of uptake in terms of participation. We've also seen series of negotiations, series of agitations, and certainly I believe a lot more has happened behind the scenes for us to get this far. I'm going to shut up and just get the experts to do the talking from here. I'll come back with a set of questions, and definitely we'll open this up to you, audience, to share your perspective, ask questions, and that's how we create insight to help us support the program. I think it will be important for us to get a sense of what are the necessary conditions for success from here. But it's also good to really look at the implications for the banking sector, certainly for the wider economy. So I'm pausing, and Philip, inviting you to share your perspectives on the domestic debt exchange program, the implications. And so, Philip, I hand over to you.
Well, Robert, thank you very much. And thank you very much also for the kind words and the introduction. Let me just say a very good morning to you all. And then first, let me thank the Banking College for extending an invitation to the Bank of Ghana to participate in this important program. The debt exchange exercise itself, I don't think it's a very trivial exercise that has been embarked upon. It's a big issue. And I think I'm glad I'm participating in a program like this, at least to be able to share some of the insights that I've gained by participating in the meetings and the program as well. So as Robert said, my job here is very simple, and I'll basically be outlining the potential impact of the debt exchange program on the economy. But I'll do this in a simple way. I've been thinking about this ever since the invitation was thrown out to the bank and they asked me to participate. And I've been thinking about a very simple way to go about it. So I'll be looking at it, at the potential impact basically on inflation and on growth. Looking at where I'm coming from the central bank, of course, what matters to me is the inflation impact, is the growth impact. And of course, if you look at the inflation and growth impact, there are so many channels through which the domestic debt exchange program will impact on inflation and growth. And the channels could be coming from the fiscal channel. The channel could be coming on the impact on the banking sector as a whole. The channel could be coming from other sources, which I think, given the time that we have, I'll briefly touch on these areas, and then we can be ready to handle questions during the Q&A. So basically, in looking at the potential impact on growth and the channels through which this will likely happen, I'm looking at it based on the fact that there might be no other significant shocks down the road as we move through this process. The first I would want to talk about is the impact on inflation. And I choose to talk about the impact on inflation because it is our mandate as a central bank. And of course, we should be concerned about that. And the economy as a whole should also be concerned about inflation, because the inflation outcomes drives everything we see in the economy in terms of interest rates, in terms of how agents behave in the economy. And to be able to do this, to be able to discuss the impact on inflation, I'll first open the discussion on the impact on government's fiscal operations. We have heard every now and again how compensation and interest payments take up a large portion of government's resources. In fact, if you look at budget execution for 2022 alone, what we saw was that close to about 100% of domestic revenues available to government went into compensation and debt service payments. And when I talk about compensation, I'm basically talking about salaries and wages, and then pension payments that government makes. So that and the debt service, which is interest and principal repayments, took close to about 100% of domestic revenues. The success in the domestic debt exchange program then suggests that with a collapse in the interest payments alone, which consumes about 62% of total revenues, if the debt exchange is successful and we have a collapse in interest and principal repayments, then some gains are going to be made. Of course, some fiscal space will become available in the fiscal framework, and then this will eliminate the need for financing from the central bank. Again, I want to use this platform to also talk about the financing from the central bank, which the central bank has explained over and over again why the financing was necessitated. And the financing was necessitated to prevent a domestic default. And therefore, I'm sure you all heard in the past 2 weeks or so, the central bank put out a statement which said that we had finished looking at our books and the overdraft for 2022 came to about 39.7% or 37.9%. I'm not too sure the number. 39.7 billion Ghana cedis was used to finance the budget. And again, here, I want to emphasize that the financing of the budget, the amount did not go for the purchase of goods and services for government or for critical infrastructure projects, but these amounts went solely to deal with a domestic default, that is, investors who had their bills maturing, for which government did not have enough resources to pay. The central bank stepped in as a lender of last resort to provide that liquidity to the holders of these instruments to ensure they earned their income on these investments, for them to also embark on their activities as far as running their own personal lives are concerned. So what basically we are saying is that success in the debt exchange will eliminate the need for such financing from the central bank. And we all know what central bank financing does. It adds on to inflation in the economy, and there's always the need to tamper with central bank financing to ensure that inflation moves in the right direction. We may all recall in the year past, we have touched on the issues of inflation and the driving factors. Robert touched on it in the beginning, the factors such as the effect of the RU war, the Russia-Ukraine war, the global food prices, US monetary policy, which resulted in a stronger dollar, and the fiscal dominance issue. So the fiscal dominance issues is what led to the central bank financing of the budget. And all these things added up to that inflation that we are seeing now. And we are saying that if we are able to deal with this domestic debt exchange successfully, we will eliminate one inflation risk factor, and all these things will bode well for inflation in the future. So yes, what I'm basically saying is that with a collapse in the interest and principal payments, The principal interest and principal payments alone also constitute about 62% of budgetary resources. Enough space will be created, and the need for central bank resources will be eliminated, and the impact on inflation will be favorable. We all know what happens to an economy where inflation remains favorable. We will continue to see a quicker disinflation as we all expect. And then when the central bank, is fully convinced about the downward spiral in inflation, the central bank will then begin to ease on its policy rates. And then the expectation is that this will trigger down to other rates in the economy. And then again, that will also have certain effect on the rest of the economy. Quickly, I'll touch on my second point, which is on growth. Now that I'm talking about central bank easing its interest rates when it is confident that inflation has begun to ease in the economy. My second point is on the impact on growth. And here I will want to briefly touch on three main channels. Again, the fiscal policy channel, the banking sector channel, and then the confidence channel. So I'll briefly touch on these three issues. The first is on fiscal policy. And here I want to touch on the fiscal space that will be created as a result of a successful debt exchange. That space created can be rechanneled into critical growth enhancing expenditures that will drive growth over the long term. The second point on fiscal policy is on crowding out effect. And here, what I want to say basically is that with the creation of fiscal space and implementation of sound fiscal policies, we should see less borrowing demand for resources from governments. Banks should be lending less to government, and we should see a rediversion of resources to the private sector to boost economic activity. But to make meaning of this, interest rates should fall to trigger also a demand for resources from the private sector. So it's a two-pronged approach. The private sector will need an incentive to demand credit from the banks, and then the banks should also be awash with enough liquidity to be able to lend in the private sector. I think in sum, we are likely to see the banking sector being awash with resources from the way I see it. And why am I saying this? Talking about the banking sector being awash with resources, we also need to be mindful that in acknowledging the impact of the domestic debt exchange on the banking sector, which is no smaller thing, the central bank is also giving back some regulatory liquidity reliefs to the banking sector. Banks will now have to look deep to the economy and see where these resources can be redirected. Will the banks be looking at lending to the real estate sector of the economy, lending for mortgage purposes? What does the increase in real credit mean for non-performing loans? Of course, the more credit that is being granted, the tendency for non-performing loans to rise will also emerge. And again, this raises other issues for the banks and for the central banks. On the banks, they will have to increase their monitoring. On the central bank, we will need to heighten our supervision to ensure that we are not saddled with a lot of bad loans in the economy. And these are all issues that will come up, and the banks will have to put in all these strengthened measures to forestall increases in bad loans. I think I'm running out of time. And the last thing I would want to touch on, which is my third point, is on confidence. Confidence is also another channel which impacts the economy. And I think we have all seen how the uncertainty factor has played out in the debt exchange exercise. I think when Robert started his submission, he talked about 5 deadlines. 5 deadlines. Of course, this is enough deadlines to create uncertainties in the minds of investors and economic agents. 5 deadlines. And this has created enough uncertainty. This has led to disinvestments. Individuals took out their monies from financial institutions because they were unsure of what the terms of the exchange was going to be. Banks, other financial institutions had to cope with increased requests for disinvestments, not just on Government of Ghana bills and bonds, but also on other investments. So I think what is clear is the fact that the degree of uncertainty seemed to have abated when government announced it had achieved its participation target for the domestic debt exchange, and it sends a strong signal that we need to work on the confidence factor. These confidence issues will linger on for some time, and we will need to work hard to bring back confidence. And trust me, that work is not going to be easy to bring back confidence. We'll be dealing with issues like how long is it going to take for confidence to bounce back? What is the medium to long-term effect on government's ability to raise financing from the domestic market in future? These are all issues that we'll be observing as we move through this process. But the issue of confidence brings back to fore the issue of communications and communication strategy. And this is an area that we need to invest in. I'll stop here and bring my initial submission to a close. Thank you very much.
Thank you so much, Dr. Philip Abredu. You've really highlighted the implications for inflation, certainly fiscal deficit, and you've touched on confidence. So thank you for sharing the perspective and what this means and how the central bank has been supporting in terms of the deficit financing. Thank you. We'll move very quickly to Professor Noel Tego to share his perspectives on the lessons so far. Prof, if you can hear me.
Okay, I can hear you very well. Thank you very much. So what I propose to do is just three things. The antecedents, that things that happened before the exchange. Two is how we handled the domestic debt restructuring. And three is the overarching lessons that we should learn. So the first, in terms of, let me start with the antecedents. I will just make a few quick points over there. First of all, I mean, in 2019, particularly in December, the IMF, the World Bank, published a joint paper on the debt sustainability of Ghana, and they started posting warning signs in there. At that time, COVID had not hit. Other things, Ukraine and co had not hit yet. And the warning signs were there. But we seem to have been very optimistic about the resilience that we have as an economy, and oblivious of the fragility, if you like, of the debt situation and vulnerability to any major external shocks if they occur. First lessons, let's adjust from being overly optimistic into being realist. I quote to you someone, as a word who says that the pessimist complains about the wind, the optimist expects things to change, but the realist adjusts the sails in order to move in the direction of the wind. And I think we must be realists as the economic managers should be. And then, still on the antecedents, we're hit by the external shocks, COVID, and then subsequently the impact of the Russia-Ukraine war. And we should have learned at least two things from this. You see, these things made our fiscal situation more precarious, and this should have called for, if you like, almost crisis level management of the fiscal space, but we did it. You know, in my view, it would have included putting a lot of projects on hold for which we were contracting loans. And we kept contracting loans even when these things were taking place. and we kept drawing down on loans, etc. in terms of that. And the projects that we are doing, most of them are not complete. So we are not even getting the economic benefit of that anyway. So why did we do that? Lessons learned for me over there is that we ought to be careful in terms of the amount of money that we spend in those things. The other thing is that we should have started thinking about how to address the debt sustainability and even at that stage, and even arguably using international debt relief, but we neglected those things. And we're very reluctant when things hit, even to go and seek external help. We should not leave it to the last minute in order that we would do things like that. We left it to the last minute. And the lessons learned is that when you leave it to the last minute, the impact exacerbates, and you have to take, if you like, a much deeper and much more fundamental, and therefore much more hurting reforms if we have to do that. Now, let me come to a couple of issues in the process that we handled. Philip was very much the central banker that he was, or that he is, in trying to be quite even about what he talked about in terms of the impact. For me, if you ask me to describe it in one word, it is seismic. And it's as if there's been an earthquake that has shot through the whole economy of the country. And when earthquakes take place, there's carnage, there's wreckage, there's havoc, and that seems to be where we are. And the havoc and the wreckage affects many, many, many things that we would come to haunt us in the future. But then also with every earthquake, there are aftershocks. And I think some of the aftershocks, Philip alluded to it, which is confidence, not only within the financial and fiscal space and the financial market, but even confidence in the economic management of the country and confidence in the political process. And these have put us in fragility, democratic fragility and other and governance fragility that we shouldn't have gone through. We should learn the lessons from that. But once we decided that we're going on the external debt, we decided on the perimeters over there, and we kept changing things. We've talked about that. Not only deadline changes, but we changed, importantly, the type of debts that we were going to, the type of creditors that we're going to deal with. At one stage, pension funds were included in the creditors. At another stage, they were not included in it. At one stage, individuals were not included in it. At another stage, they were included in it. And not only that, we kept changing also the terms of offer that exists. And this, for me, reflects a lack of meaningful and broad and transparent consultation with people involved. So lessons learned, let's consult more widely, more meaningfully, because knowledge does not reside within only the economic managers. But at any rate, I mean, if you owe me money and you can't pay me the money, you've got to start thinking about engaging me in a more respectful and realistic terms. And then we talk about now about 85% of those who are eligible have subscribed to that. Again, this beggars belief for me, because at the start of the national conversation, we were operating on a denominator of about 137 billion. Arguably, let's say it's now 130 billion because over time, some of the debt has been paid off. If you look at those who have subscribed, they are more 65% than 85%. I think when public servants and others speak, there has to be truth and honesty in what they speak, because that is where confidence and trust will come from. And then so hovering on the 64%, I think the lack of take-up what is a credibility issue for me, really. It's a credibility issue for me. Because if you look at others, Jamaica and Barbados and others, they had nearly 100% take-up. And the main thing was that there was a credible message. And the credible message and a compelling message centered around burden sharing. So there was clear policy about government sharing the burden and not only others, the creditors sharing the burden. And more recently, we have heard the German ambassador to Ghana making statements like that, that if we expect external help, then you see the external help is going to come from taxpayers of other countries. And they would have to, they are sharing our burden. Why wouldn't our governments and others in the public space share the burden with them? So for me, lessons learned in this area, do broader and more meaningful consultation. And if you do that, you will kind of identify the issues and engage people and solve them. You won't come with the chaos and the confusion that comes. And when we are communicating, Philip, thank you for mentioning communication strategy. The communication must be clear, simple, everybody understands what is there, no obfuscation in terms of what haircut is and what haircut is not, and so on. It must be credible. People must believe what you're saying. And if you are changing the goalposts, etc., and you are not admitting, we are not admitting the real nature of the mess in which we are, then it is not credible. It must be connected to the different activities that we are undertaking and the reasons why we are where we are at the moment. I didn't see that in the communication at all. And it must be compelling. And for it to be compelling, we must establish a burning platform so that people will see that, look, if we don't do something about this thing, we are going to be in trouble. But if some people are being asked to bear the burden and others who are in a position to even bear the burden are not, then there's no compelling case at all. Why should I bear the burden that some other people will not bear the burden? But anytime there's a compelling case, then we know that it animates and motivates people to action. And we've seen that in previous domestic debt exchange programs or domestic debt restructuring programs that are taking place across the world. I'll leave you on that note with what one of the accounting firms, EY, says. It says, make the complex simple and make the simple compelling. That is good advice for government. And so finally, I'll talk about overarching issues. First of all, fiscal discipline. I mean, we've had debt reliefs upon debt reliefs, and then which is the alternative to debt restructuring. And there's always been fiscal recidivism, in my view. It's like you offend and then you are pardoned and then you go and offend again. That is not the way to do things. So we have to ensure that we improve our revenue, widen the tax net. It's always been said there are strategies to do that. Happy to talk about it through question time. Stop the leakage in the collection. And then we've got to control expenditure. We have to be able to control expenditure. And there is a perception, whether it's true or not, I don't know, but there's a perception that we undertake projects because and other procurement-related activities for personal and political gain. In other words, there's a lot of corruption riding through the system. And so why? I mean, why would we want to do that? I haven't seen any analysis of major projects that we've taken undertaking that says that these are the economic benefits it's going to give us. Post-implementation, come and do a post-review over a period of time to actually demonstrate that the projections we made are the projections that we achieved. And if we didn't achieve that, why? Was it policy from the policy side? Did we get it wrong? Or if it was in the policy side, was it a implementation and execution side? We've got to do much better than that. Again, I'll say, let's look at the structure of our economy. That's number two in terms of overall overarching things. You know, focus on manufacturing, too much imports. Let's do a lot more value add, because you see, when we import, we are paying other people somewhere. Go to countries like India, you see that most of the things that they consume, they import themselves. And then for me, there's a whole notion of what is the national development narrative. We need a national development narrative properly, widely consulted about, and getting the buy-in of the political class so that we know what we are going to do. And as a government council, they choose what is priority within their political space, under the basis of the national development narrative, and they execute in terms of that. Not much time to deal with that, but let's talk about it. And then fourth thing under overarching thing is deal with corruption. The perception of corruption is bad enough, but the incidence of corruption is even criminal, and we should deal with that. And then we should start thinking about the transformation of our economy. And when I talk about transformation, I'm not talking about mere change. I'm talking about, because change means doing things differently. For me, transformation means doing different things. And then the final thing is that I'm calling for leadership to step up. And I'm not talking about the presidency, a particular political party, or even only the political class, but leadership across the spectrum of Ghanaian life should rise up and begin to tackle the challenges that we have and call things for what they are. I'll leave you with a quote from one of the greatest statesmen that walked on the face of the earth in the 20th century. It's Winston Churchill. And these are addressed to the leaders. He says that a positive thinker sees the invisible, he feels the intangible, and he achieves the impossible. And what might seem impossible for us at the moment requires us to begin to have leaders who are positive thinkers, who can see the invisible and feel the intangible, so that they will be able to achieve the impossible. Thank you very much. And Robert, I hand back to you.
Thank you, Prof. Professor Noel Tego, sharing lessons, and he touched on the antecedents, the warning signs, and described this as quite seismic in terms of impact, likens it to some earthquake and the aftershocks, and touches on transparency and credibility from policy narrative perspective, but also the burden sharing. Then on communication, that we should be clear, credible, connected, and compelling. Then overarching lessons, fiscal discipline, structural reforms, national development narrative, and we need to deal with the corruption perception and incidents. And then, of course, landed on leadership, should see the invisible, feel the intangible, and do the impossible. What a way to land. Thank you, Prof. We would open this up at some point, but I want to interrogate some of the areas that have been touched on from the two perspectives that have been shared, both from Philip and certainly from Prof. So let me find out, starting with Philip. It appears we know the problem. We know where we are now. What we're not too sure about is what the future looks like. But certainly the variety, if you like, the overall aspiration is to be able to do a deal with the IMF, get some 3 billion to stabilize the economy. I see from some of the statements issued by government, particularly Ministry of Finance, we are doing this to restore macroeconomic stability. We want to achieve debt sustainability and want to drive economic growth. Question: are there alternatives to what we have done so far? Particularly if you look at the debt exchange approach that we have taken. Are there other ways we could have done this? The overall objectives from Ministry of Finance's perspective is quite clear, but are there alternatives to the approach we have taken? Philip, you want to make a start?
I would want the Prof to pick up this question.
All right, sure, Prof.
I would want the Prof to pick up this question. Thank you.
All right, Prof.
Philip, you're either a politician with a small p or a diplomat. So choose what makes you comfortable on that. But let me say a few things. I think we got to the point where we had no other option than to do some debt rescheduling, debt restructuring, and so on. that's what we got to the point. My argument is that we needn't have gotten to the point to invoke certain other alternatives that we could do. So some aspect of debt relief that was open to us, my understanding is that we didn't take that to provide the space for us. The second alternative was to have reined in our expenditure way earlier than that. And I remember an interview that I made once on Joy FM, and I likened coming from COVID, someone coming from, if you like, intensive care. And as soon as you come, you're running and you are moving at speed. We could have done better than that. Now, is it that we did not know that we shouldn't have spent that much? I think that the political, I'm not talking about one party, by the way, but the political class know that. But there seems to be some political advantage rather than, I mean, those expenditures responded much more to the political cycle than they responded to the economic cycle in terms of that. And that must be looked at. Of course, it has been alleged that it also responds to the personal cycle, and that we have seen that throughout the Fourth Republic. If that is the case, that must be addressed. So those are alternatives in terms of that. Were there alternatives in terms of whether we should do domestic exchange or not, debt exchange or not? Domestic debt exchange is a huge amount. I think it's about 42% of the debt stock as of September when we were talking about it, and therefore you have to do something about that. In that case, there wasn't any realistic short-term crisis-based response to that. But that you do that alone is not going to help you. That it must be accompanied by government taking realistic steps to rein in expenditure, because that is within our control. And then government also taking realistic steps to ensure that the seepage that, from the revenue side is also controlled. Those are within our control. And then we can start talking about the short to medium term approaches in making sure that we don't come into this state again. Philip, I've opened the way for you, so you probably might want to challenge some of my naive outsiders' perspective or affirm some of that.
No, I think you have really touched on the main key salient areas, and I think these are the issues going on in the minds of people. So I think on that basis, I have nothing more to add.
Sure. Thank you, Prof. What I hear is that there's no realistic short-term crisis-based option. So we are really stuck, and therefore we are caught between the devil and the deep blue sea. So maybe let's move the conversation forward. So I said earlier on, and I think Philip, you kind of alluded to the fact that, see, we are doing this certainly to bring inflation down, to achieve some macroeconomic stability, and financial sector stability, of course, their sustainability. My question is, what are the necessary conditions, given where we are and given where we are, really stuck at? What are the necessary conditions for success? And I ask that also conscious of the fact that we have a 55% debt to GDP ratio to achieve by a certain time period. Is that too aggressive? What are the necessary conditions for success, given where we are?
Are you talking about necessary conditions for success regarding the debt exchange program?
Correct, and the pathway forward, so that we don't come back here. Necessary conditions.
Well, see, the way I look at this, which I think initially you started talking about it, is on whether we think that beyond the debt exchange, macroeconomic stability will be guaranteed.
Sure.
So do we believe that after this debt exchange, we are going to see macroeconomic stability? Are we going to see growth pick up? Are we going to see inflation come down? Are we going to see interest rates go down so that the private sector can do what they need to do to bring back economic life? So I think for me, these are the issues at stake. And then again, beyond the debt exchange, what institutions are we going to put in place to ensure this does not happen again? So I'm a strong believer of institutions. We need to get the institutions working. We need to get the institutions ensuring that issues of debt becomes central in our discourse. We need to put these things at the doorstep of the legislature for them to put in place very sound, tight, and credible legislature to forestall the recurrence of what has happened now in the future. So for me, institutions really matter, and I think that is how we should be looking at it going forward. I mean, if you look at the discourse on this debt exchange program, there are those who believe this has happened before in the past. There are those who liken what is going on now with what happened during the HIPC era. But the question is that fast forward from the HIPC era, we seem to have come back to the same point. We need to do some introspection to what has gone on and how we really got here. Do we have the right institutions in place? And if we do, did the institutions fail or we don't? And if we don't, do we need to put in place other institutions? Do we need to lock in certain things in law to prevent some of these things from happening again? Do we need to set debt limits for ourselves internally? And how do we abide by these stringent debt limits? For me, these are the issues at stake. And these are the things that we need to work on. When you have strong institutions complementing a strong macroeconomic environment, then everything seems to move on in a seamless fashion. And economic activity is restored, growth bounces back, inflation will decelerate to where it has to decelerate, and everything will be working nicely. And then maybe the other things that we need to deal with is how to reposition the economy to deal with external sector shocks as and when they come. But even for external sector shocks as and when they come, we need a very strong buffer. And that buffer is macroeconomic stability. We need strong reserves, we need fiscal prudence, and we need strong institutions. These three pillars, for me, are the three things that I would watch as we move along. Thank you very much.
Thank you, Philip. I hear in your submission the need for strong institutions. I think it was Obama who told us when he was here that, yes, we do need strong institutions, maybe not strong men. Perhaps we need both at this time, right? But I see where you have landed. Absolutely right. We need to have the institutions being strong and the macros being strong and being fiscally disciplined and prudent, as you put it. So thank you for that. Prof, if I pivot to you.
Robert, can I just make a comment on those conditions for success? So I'm kind of pivoting onto that.
Yes,
and then you can make it.
I was just going to bring that to you. But you touch on, I want to link that to the leadership side of things. You indicated you were not talking about the political leadership. I'm
not talking only about the political leadership. Certainly they're included.
Only, oh, okay, excellent. Thanks for correcting me. I sense, is there a failure on our part, people like me, the so-called middle class? Are we dormant? Are we missing? Are we showing lack of leadership as well, in terms of what you said? And therefore, do you consider that a necessary condition for success going to the future? But Prof, over to you.
Okay. So a couple of things before I address your question on leadership. Number one is that if we implement, we expect fiscal space to be created. And so the question is, what do we do with the fiscal space that is created? And Philip had mentioned that, can we have something that would ensure that we don't come back to this? That is key. Number two for me is that we should focus a lot on confidence restoration in the investor community, the domestic investor community. That is very, very important in mobilization of resources and savings into the sector. I mean, people had begun saving monies for life cycle events, like children going to school, etc., and things like that. Those monies are being withdrawn from the system, the financial system, and so on and so forth. Those things, we have to buy back confidence for people in order for that to happen. So confidence boosting mechanism should be in place. The third thing for me is data. We've got to be able to know what is happening in the economy. And for those of us who are accountants, I mean, we are not as enlightened as economists probably, but we talk about 4 types of analytics of data. Number one, we should know what has happened. And normally we know what has happened, not all of it, but maybe the bank and others know. So that's what we call descriptive analytics. Number two, we should know why it happened. And I have not seen any credible document or any discussion about looking at why it happened. That's what we call diagnostic analytics. And then we should then be able to shift from the diagnostic analytics to know what will happen, which is then what we call the predictive analytics aspect of it. And then finally, we should think from the predictive analytics, if you know what will happen, then how do we prepare ourselves to take advantage of what will happen if it's good for us, or to mitigate against disaster if it's not good for us. And that's what we call prescriptive analytics. Now, so I haven't seen in most of the national policy document, an addressing of the diagnostic in any meaningful this thing. We limit ourselves mostly to the descriptive. I haven't seen a lot about the predictive, and we just move on to the prescriptive. So there is, if you like an analytical and conceptual gap over there, and that affects credibility, and that possibly also affects the connectedness of the policies that we are doing. So data. And then let me come back to what you talked about, Robert, in terms of leadership across the board. I would say that we need to start with the leadership of the political parties. It is in Ghana that when an election takes place, then you have, it takes 6 months, close to 9 months to have the full ministerial portfolio. Whereas in the United Kingdom, as soon as a prime minister is changed, within 2 or 3 days, almost every position is filled. Why? What's wrong? Because a leadership vacuum is created. And I suspect that most of the time, our policy space from the political parties are not there. We have just slogans. We have a laundry list of things we want to do, and we put them in manifestos. We've got to start taking policy making very seriously insofar as we are concerned in terms of that. The other thing then is for every leader, there has to be the issue of integrity and trust. And the leaders must model national development aspirations and the kind of things they're asking us to do. So if you're asking us to tighten our belts, let's tighten our belts. And then we speak too much. There's a lot of talk in Ghana. You know, go to Rwanda, let's talk, more action. They're doing things. And it's Benjamin Franklin who once said that well done is better than well said. We've got to move into that. I'll close again with another quote. This is something, I mean, two quotes actually. Andy Groves was one leader who said that, look, crisis, okay, destroys bad companies. Good companies survive them, but excellent companies are improved by it. Let me apply it to Ghana. Crisis will destroy Ghana if Ghana is run badly. We will survive crisis if we are run well, but we'll be improved by the crisis if we are run in an excellent manner. Then the final thing I'd like to leave with you is something by a writer called Brian Carroll. He said that there are three types of people in this world: those who make things happen, then the second type, those who watch things happen, and the third type, those who wonder what the hell just happened. And since that we have parked firmly as Ghana in the area of either watching things happening, then we praise ourselves, or in the area where we ask, what the hell just happened? And many people are asking us this question, what the hell just happened? But we ought to move to the first stage, those who make things happen. That's the challenge of leadership for us at the moment. Thank you, Robert.
So thank you, Prof. Well done. It's better than well said. We talk too much. More action is required on our parts and across all spheres. Thank you. I just want to move the conversation forward. I'm conscious we've done about an hour, 7 minutes. And at some point, we need to open this up to our audience. And I'm conscious, Philip, I see your hand is up. Do you want to make a submission before I move the conversation forward, Philip?
Oh, yes, just a few points on what Prof just touched on.
Sure.
I think he's touched on very, very crucial issues. He talked about data. The way he emphasized on data. I liked it. He's talking about we need to know what has happened, why did it happen, what will happen, that is the predictive, and then preparedness towards mitigation. And then he went on further to say that he hasn't seen any document that has outlined some of these things. But I think it's all about how transparent or how information sharing the system is, because some of these things, you might find some of these things in the central bank, but as to whether some of these things can be put out there in the public domain from the central bank, at times it's a little bit difficult and a little bit challenging to see the central bank, quote unquote, which is part of larger government, putting out some of these things. It might sound a little bit, should I use the word incriminating? But some of these things exist. But then it takes me back to my whole issue about institutions. Do we need an institutional framework that will ensure that when some of these things are being done and some of these things are being shared interministerially between departments, between the agencies of government, these things are made known to the public? I don't know, but I think the Constitution also provides some provision where public officials could be invited to, let's say, Parliament, to sort of explain some of these things. And then again, it takes me back to the question, are these institutions exerting the mandate given them to try to find out some of these things? Because if they push, I'm sure they will get the answers. So some of these things are there. One other thing that he touched on, which also touched me, is the time it takes to go through ministerial appointments. 9 months. That is pretty much a long time. And then again, it takes me back to the institutions. Do we need to amend certain portions of the law? Is it the law? Is it the Presidential Transition Act that we need to look into again to amend, to give meaning to some of these things? Because if you waste 9 months, which is almost a year, going through an appointment process, basically you have just about 3 years, 3 months to deliver on your mandate, which is too short a time. And then again, that issue also takes me back to the question. People are saying that is the 4 years too short? Do we need 7 years for a political party to execute its mandate? These are all part of the reforms that we need to look into as a country, and then take those bold steps to bring about reforms and change. So, Prof, thank you very much for those points. I think they were well said. Thank you.
Thank you very much, Philip. Thank you for your submissions. It's interesting, Prof, you talked about crisis destroy bad companies by stretching that bad countries or countries that are badly governed. Good companies survive them, and great companies are improved by them. So I'm conscious that our key stakeholders, financial services sector participants or practitioners, and we have quite a number of them here. So I'm also aware that crises also present opportunities. I'm told that the Chinese write the word crisis with 2 brush strokes. One stands for danger, the other certainly stands for opportunities. So what are the opportunities, and what should banks or financial institutions be focusing on more strategically to weather the storm, and certainly improve their lots and become great companies, if you like? Prof.
Okay, so again, as we say, there are opportunities for every crisis. A couple of things I'll say. One is know your customer, know your customer, know your customer, both in terms of the liability side, but also in terms of the asset side. And you see, when banks think about knowing their customers, they think about it only from the regulatory perspective. And they are thinking about it. In fact, the message is, we don't trust you. You're a bastard. You could run away with money. You go and do money laundering and so on. I mean, that regulatory, that risk and regulatory approach is needed, but it must be balanced with a business opportunity approach. That we want to know you to see how we can serve you better. Because you see, he who solves the customer's problem gets the customer's money. End of story in terms of business. There's nothing difficult about, there's nothing complex about that. It might be difficult to do, but it's not complex. It's simple. So a bank should try to know their customers. And this is because, you see, in the current crisis in which we are now, the economy has gone down. And I argue that there are 3 types of sectors or companies in any economy. There are those who are pro-cyclical companies or industries. There are those who are anti-cyclical industries or companies, and those who are acyclical. Let me explain. The pro-cyclical, they go according to the direction of the economy. So the economy does badly, they will do bad. Then the acyclical, country broke, country no broke, we're there inside. The anti-cyclical, the economy does badly, they do well. So let's assume that the economy is doing badly at the moment. There are companies who are doing well in terms of that. So the banks ought to be able to deepen their relationship management in such a way that they are able to identify within their portfolio of customers who these ones are. And then we know that we have foreign exchange issues. What about exporters?
Prof,
of
it
them
appears
would
we
need.
lost you for a while. If you can hear me, please carry on.
Okay, I can hear you. Can you hear me, Robert?
All right. Yes.
Okay. So let me backtrack a little bit. What I'm saying is that whenever there is any crisis, okay, you run into three types of companies, and it depends on how those companies relate to the economic cycle. There are some, those are the pro-cyclical companies or industries. And then there are those who, when the country or the economy is doing well, they don't do well. When the economy is doing badly, they do well. Those are the anti-cyclical companies or industries. And so you've got to have them. And then there are those who are acyclical. It doesn't matter whether the economy is doing well or not. They have means by which they will survive, or if they'll fail, they'll fail. Now, what I'm saying is that banks, the opportunity resides in knowing which of the clients are in these areas and how the banks can readjust their portfolio to them. Because see, the opportunity that exists now, I don't want to invest in government bonds. Are the banks going to create some product for me, innovatively, for me to park my excess money over there? Or should I park my excess money in the UK, for example? Now, those are the kind of things we've got to talk about. And it will depend on how they classify me as a customer or my company as a customer and so on. I don't have the time to go into detail, but banks will know how to deal with these things. That's one of the opportunities that we realize over there. And then there's an opportunity for us to reset in terms of expectations and so on. Let us now try to reset, because we're in a crisis already. Let's reset. I mean, for those of you who have done anything about income smoothing and things like that, you know that as soon as a new CEO comes, and because of a crisis, we have what we call the big bath. You put everything that was wrong in the reset, get another baseline, and begin to move on from there. We've got to reset insofar as we are concerned. And then let me just say that the opportunities are for those who are not going to be hampered by the status quo. We've got to reframe and think differently about the issues that are there. And let's place the customer at the center of that, whether it is from the liability creation side or the asset side. There are customers who are there. And I'm saying from the asset side, look, we have opportunity. The banks, you would have thought that lending to SMEs and others were more risky. Now you are left with, whether government calls it haircut or not, some form of reduction in present value of your assets. Beginning to diversify the portfolio and begin to take SMEs and others very seriously. And the opportunity that will be created by the fiscal space that Philip talked about, which they should be able to use it. Because if there's fiscal space and government is not going to borrow more money from the banks, and so government is not going to crowd out, then we should see the banks moving in the direction of supporting the real economy more than anything else. So that's within the time space I have, that's what I'll say. Robert, back to you.
Sure. So thank you, Prof. I see quite a number of comments that are coming through. Please keep them coming in. We'll read them, and for the questions that you have, we'll give you the opportunity to ask them directly to our panel members. Perhaps the question on my mind, and I think people have asked extensively, which is to say, we know where we are. Prof, you've talked about the opportunities as you see them. Question is, confidence has been damaged significantly, market confidence, customer confidence. And I know you talked about deep relationship, and I suspect that will go with having good knowledge and data about customers as well. But how do we renew, how do we rebuild, and how do we, if you like, restore customer and market confidence? Philip, I'll start with you. More from the regulator's perspective, things you are doing to ensure that the market confidence is restored, renewed, and rebuilt. Hi, Flip. Can you hear me?
Hi. Yes. So, sorry about that.
No, that's okay.
Well, so I mean, you recollect in my initial submission, I touched on the issue of confidence.
Correct.
I started off by talking about inflation, growth, and then the confidence factor, which we should not disregard in all of this exercise. And from the regulator's point of view, we have taken note of the potential impact of the exchange of the banking system. And therefore, our duty and our role is to work with the banks to ensure that they stand as strong as ever to be able to deliver on their mandate. That is the only way we can ensure that the confidence in the banking system is regained. And then, of course, yes, preceding that is the macro stability issue. So macro stability in itself brings about confidence. But beyond that, we need to work with the banks to ensure that people continue to have faith in the banks and deal with the banks, because that is where monetary policy is transmitted. And if the central bank fails to work with the banks to ensure that confidence is regained, then our work will be meaningless. And to be able to do that, I think on December 5th, the Bank of Ghana working with the banks. And I must tell you that there's been series and series of meetings that have taken place between the BOG and the banks. We have listened to the banks. We've taken their suggestions on board. We continue to dialogue with the banks all the time to try to ensure that the impact of all of this is minimized on their operations. The Bank of Ghana has announced some measures to help manage the potential impact and preserve stability. And we've designed some regulatory reliefs for the banks, which I think all of you know about. I don't need to go deep into these regulatory reliefs, but I think on the top of my head, we have about 10 of them. We are still talking with the banks. We might bring on board more regulatory relief measures if need be. But I think on the top of my head, what we've done is that recognizing the liquidity impact on the banks, the Bank of Ghana is reducing the cash reserve ratio from 14 to 12% on domestic currency deposits. I also think that there's also a reduction in the cash reserve ratio from 13 to 12% on foreign currency deposits to be held in foreign currency. We are also reducing the capital conservation buffer from 3 to 0, effectively reducing the minimum capital ratio from 13 to 10%. And all of these things are designed to give back liquidity to the banks so they can meet their short-term daily needs to continue to foster confidence in the banking system. There is also derecognition losses coming from the debt exchange, which shall be spread equally over a period of 4 years for the purposes of computation of the capital adequacy ratio of the banks. The banks have a maximum of 4 years to restore their minimum paid up capital as a result of any capital shortfall arising solely from derecognition losses. So we recognize that the capital of the banks are going to be impacted by this exercise, and we are giving them a time frame to restore these capitals back. There are other issues regarding regulatory tier 2 regulatory capital, which is also being altered. Reduction in the minimum common equity tier 1 capital. We are reducing that from 6.5 to 5.5. We are also increasing the allowable portion of property revaluation gains for Tier 2 capital computation. So there's a lot going on to ensure that the banks are not unduly burdened. So we've introduced liquidity reliefs. We are also bringing on board some regulatory reliefs. We are giving them time to restore their capital. And then again, there's also talks going on with the World Bank to establish a framework for establishing the Financial Sector Stability Fund, which when it becomes operational, should the bank have solvency challenges, the banks can tap into this solvency fund to ensure that the bank continues to operate as a viable entity. So you put all these things together, it's designed to bring back confidence and to give confidence to people out there that the banks are not going to reel under the domestic debt exchange. From the regulatory side, there's a lot going on to hold our banks. That is all we have, and we will continue dialoguing with the banks on this very issue. Thank you very much.
Thank you, Philip. I see quite a number of questions for you,
Okay.
particularly what you do to make sure that no bank goes under, and you know, a number of other questions. But we'll come to the questions very, very shortly. Prof, I'm coming back to you on this market confidence conversation, right? From the regulator's perspective, there are quite a number of things, and they all seem regulatory in nature. Where's human capital in this? And also, maybe more from a lesson perspective, if I sit here as an educational institution, you know, leading an educational institution, professional bankers, I think the way we teach financial management and financial instruments, based on our experience here, it's completely disrupted. I'm not sure whether we can call any instrument risk-free going forward. So how much of human capital conversation should we be having in terms of people who lead institutions, not just from banking sector, but also public sector perspective? How do we situate human capital? And I said this conscious of the fact that I'm told Kofi Annan said that when God created the world, he left a big hole in the center. He put the remaining resources from all the other parts of the world into that big hole. And when the angels asked him, he said, wait until you see the people I've put there. And so the moral of that story is that the problem of Africa is not lack of resources, but people. So I'm asking the question, in restoring confidence, how do we situate the human capital in this from ethics, professionalism perspective? Prof, let's hear your thoughts on that.
Okay. Thank you very much. To which I add that I've been in prayer meetings of very senior religious leaders, and they were saying, praying to God for blessings. And I stopped the prayer meeting and said, please don't pray for that blessing. What is gold? Isn't it blessing? What is oil? Isn't it blessing? What is our forest reserve? Isn't blessing? Pray for us to be able to have good leaders and then the right human capital to be able to use these for our benefits. So in terms of that, you're kind of I'm on a similar wavelength with you. I don't think that it's only a lack of talent and human capital. I think we have a fair bit of human capital. I wish we have more and much better than what we have, and certainly there's a lot of room there. But we should use what we have very well. How is it that Ghanaians in this country are not used to the extent that they could be used, and then they go outside and they become celebrities in their area because they are doing very well over here? There's something systemic, and probably borrowing from Philip's conceptual lenses, there might be something institutional about this that we need to address. So the processes, the interworkings of the institutions, and the place, the nexus, the connection, the link with human effort and human capital should be looked in and addressed properly. I think we tolerate too much mediocrity, we tolerate a lot of interference, we tolerate too much short-term thinking, and we've got to liberate our people to begin to think about some of these things. So human capital is clearly important for me. Our universities and our educational institutions should rise to the challenge. We've got to move away from people knowing stuff but not being able to apply the stuff. And we must situate our educational enterprise within the ability to impact and affect our environment and our context with what we know. And therefore, I say to most of them that the kind of thing that we call in education, what I call it, just in case learning, where you learn a lot of things just in case you need them. And with the world changing so fast, by the time you need them, they are already irrelevant. The perishability of knowledge is very high. So we've got to transition from what I call the just in case learning to what I call just in time learning. So people ought to be encouraged and learn the skill of learning and learning and learning and learning and learning all the time in order to address the challenges. And that learning should be contextual. It should be based on the problems of Ghana, not on what we think is the problems of Ghana or what some other people's problems are. That is an opportunity that opens for us. And then, Robert, you alluded to the fact that what we teach is might need to change. I take a different view, actually. I'm quite optimistic that this will be a temporary blip and we'll come back to the time when government instruments, etc., are risk-free assets, and CAPM will come back into ascendancy insofar as that is concerned. I stand corrected in future if that doesn't happen, and I will apologize to you if it happens. But I'm an optimist insofar as Ghana is concerned about that. Now, let me just end in talking about confidence insofar as those who lead institutions are concerned. We need a lot of vision, visionaries leading institutions. We need people who are not constrained by what I call the tyranny of the present. You are in the present already. I mean, so begin to think about a future. Imagine a future that is quite different from where we are, and begin to plot the steps for us over there. Look, I mean, we've had people like Nkrumah who could see a future that many of his contemporaries couldn't see and began implementing that. If we move further back from that, you had people like Governor Gottsberg and the rest who could see the future for Ghana and begin to imagine not a colonial economic structure, but something that was more liberating. And he did things insofar as we're concerned. And if we just learn to do some of those things back again, then we'll be better off. And that is going to come from leadership. Confidence sometimes comes from leadership. When you have a leadership that is confused or that is chaotic, and that is giving an impression that he doesn't know where it's going, where's the confidence going to come from? And by the way, just let me add this caveat. I'm not talking about political leadership necessarily. I'm certainly talking about the political leaders of the big political parties we have, but also of corporate leadership, family leadership, societal leadership across the board. Finally, put Ghana first. Put Ghana first. That inspires confidence. Robert, I'll finish my tirade.
Thank you, Prof. Put Ghana first is where you landed. Our vision shouldn't be constrained by the tyranny of the present. I'm trying to learn some of those quotes as you put them. So thank you. We will move quickly to hear from participants, audience on this call. Let me make the announcement that we know that the Zoom was initially constrained, but Teams is available and all the other social media handles. So for those who can still join. In fact, the Zoom has been increased to, I think, 250. That's my understanding. I have a few questions and I see a number of hands up.
Can I come in before we go to the question?
Just read through. Sure. Philip.
Oh, let me just come in before we slide into the Q&A. I just want to touch on one point that Prof raised. which he said that whatever is going on is a temporary blip. He's an optimist, and he's saying that he thinks that all this will be over very soon, which is what we all expect. But I think beyond the blip and beyond bringing closure to the debt exchange, it takes me back to the issue of institutions. And if we don't get the institutions right, we might relapse back into this situation in the not too foreseeable future. And we need to work on that seriously. And it takes me back to a question that I've seen on the screen from Yao Nsako to everyone. And he's talking about, are these discussions not too focused on symptoms? When do we focus on fundamental reform of our economic restructure? And again, that economic restructure for me is an institutional problem. When do we start to talk about land reforms, value chain analysis to modernize our agriculture so that we bring down post-harvest losses? These are very sound issues he's raising. The sector ministries should be dealing with these issues. And again, it lands me straight into the issues of institutions. Such issues no longer seem to dominate our thinking. We focus on optimization of a debt system. So he's raising issues which for me, I think if we're able to reform institutions and make them much stronger, we will be in a better place in the not too seeable for future. So I'm a strong believer of institutions, and I think that is where we should be gravitating. One more point. I think the prof also touched on what the banks needs to do. And this was on when he was talking about his pro-cyclical, acyclical, and anti-cyclical issues. Those who go along with the tide, those who go against the tide, and those businesses that are indifferent. And then that brings me to the issue of, he said that the banks need to do more. The banks need to look at issues differently. And it brings me to the issue of big data analytics at the commercial banks level, and whether the commercial banks are beginning to take advantage of big data to study the system, to know who their clients are, go beyond the data that have been provided at the bank level. So taking on board big data tools is also very critical. But I think we are moving into an era where the banks will now need to innovate. Innovate in the sense that, just as Prof said, we thought lending to small and medium enterprises was very risky. But this has shown us that there could be other riskier agents out there. And therefore, it changes the dynamics of the models that the banks are working on. And the issue is that, when is this change going to take place? So the banks will now need to think a little bit outside the box, innovate, take on board big data analytic tools to better understand their operations, and then move forward as a business entity. Thank you very much.
Robert, if I address Jan Sako's issue, I remember that when I was talking, I talked about lessons learned in 3 perspectives: the antecedents, when we're, and then how we dealt with the issues, and then I talked about overarching issues. And my overarching issues addresses everything that Jan Sako was said. First, I said there should be fiscal discipline. And then I did say that fiscal discipline will be aided much more if we look at the structure of our economy a lot more and move much more into manufacturing and into value added. And I see he's talked about value added, etc. Then I talked about what is the national development narrative. Those are fundamental issues. They'll deal with it. And I talked about transformation. not doing things differently, which is optimization is talking about, but dealing with doing different things. Because if you go back to the recording, I said that for me, change is doing things differently, doing the same things but differently. But transformation is doing different things. And those are the where the conversations would have to gear towards. But at the moment, where we are is that we are in intensive care, and the doctors will tell you that once you're in intensive care, deal with the patient and let the patient be resuscitated, and then you move into much longer term structural issues relating to the patient's health. And so happy to have a conversation on that, but that is where we are restructure the economy, make sure there is transformation, make sure that there's fiscal discipline, and importantly, bring this under the umbrella of a national development narrative that is multi-sectoral and that is long and long term. Robert, I'm done.
But Prof, if I may also add one last thing, you know, implementing these things require resources. And therefore, when your fiscal condition is in a very bad state, it becomes very difficult for you to move out of your current position and implement things like is being put out there. So the fiscal really matters. And I think that is why we need to keep an eye on a fiscal policy execution, because whatever happens on the fiscal gets transmitted to all facets of economic activity, all facets of economic life. And therefore, the fiscal matters, and we need to be very mindful about fiscal policy. Else, all these reforms and institutions that we are talking about can't happen. They happen with fiscal policy at the center, taking charge, and then devoting resources to let these things happen. Thank you very much.
We are in complete agreement on that. The little thing I'm going to add is that the fiscal is both a cause, but it's also a consequence of the thing, and they have a more reflexive and circular relationship with them in more econometric terms. I mean, the interaction effects would have to be modeled very carefully.
Yeah.
Excellent. So I think we should be fair to our audience, and I see I think one or two hands up. I've seen number of questions. To Noah, reference to the call for confidence mechanisms, what's your take for calls for reduction in the size of government? So that's the question, and the replacement of finance minister. There's a question to Philip. What's your comment on speculation that some banks may go under? Or so that's a question. As a result of the economic challenges, some banks may go under. We have, and this again to Philip, do you have a time frame for the restoration of macroeconomic stability that we anticipate? And after achieving macroeconomic stability, what's the plan to restore confidence in the financial system? I think we asked a question around confidence earlier. I'm going to, sorry, I'm rushing through this, but I hope you are making some notes. I can recap when necessary. To Philip again, you made mention of Russia-Ukraine war contributed to the economic mess that we are in. Can you please educate me on what exactly the war did to our economy, which brought us to where we are now? And this is from Emmanuel Jagedli. I hope I got the name right. Philip, what is the next step after the DDEP program? And what's the next step if IMF bailout is not achieved or granted? We have quite a number of other questions, but I want you to reflect on some of those questions as asked. I'll give an opportunity to Andrews Aglobi. So Andrews, please ask your question and
you
then
very
we'll
much.
combine them with a set of other questions asked.
Thank
Andrew,
you.
over to you.
Thank you very much, Mr. Jato. I've been waiting for this opportunity. Grateful for the two presenters. I have questions for the two. Let me start with the one from Bank of Ghana first. He indicated that there was some overdraft that they extended to a government. However, what I would have liked him to give us some narrative is what is the percentage of that amount of money as compared to last year, and how unusual would it have been under a normal circumstance? That is the first question. And then the second question to him is about the issue regarding the, I realized he was highly positive about how things could turn out, growth, interest rate, inflation, and all that. But you see, one major thing that we forget is there are two things that we are looking at, as you said, the interest rate component, and then the second one was the expenditure component, which is, he said that is accounted to about 100% of the domestic revenue that was raised. So now if the interest rate component is being dealt with, which you are basing your argument about how this may turn out and all that, the question I'm asking is, okay, what about if the expenditure component now is untouched, which could, that's what I'm looking at from two angles. If that is untouched, and then that could grow quickly, so that all that prediction you're making and all that, will not happen, because one of the major expenditure component I can add is you did mention about salaries, and then the pensions. There is this unfunded pension called Cap 30, which is growing. About 12 government institutions are already on that, and nobody is contributing to that. And there has been dead silence in some of these reforms that must be taking place as we are talking about what to cut. So I would have liked to give me some information about what exactly you expect that to be cut, from that angle of, expenditure, because
Thank you, Andrews. I think you have
that also can help you. And then my last question to Prof regarding, yes, he did indicate something regarding the, how do you call it? The issue that we had no option, surely, because the minister's own way said, yeah, we had no options, we had knife edge, and then there was no exemption. But my question to him is that, from his experience, could this have been addition, if we had taken addition earlier, would it have been a lot more better? Or, that's what I would have liked to get from them.
All right.
Thank you.
Thank you, Andrews. Please, may I urge you all to keep your questions short? Thank you very much, Andrews, for asking that. Let me also announce.
Can I answer my question very short? Because
yes, I'll come to you.
It would have been better if we had seen it much faster, and we would have had more options of dealing with it. But also, let me correct something. When I said there was not much options, I was talking about whether to do debt restructuring, domestic debt restructuring or not. But there's certainly leeway into how much of domestic restructuring, debt restructuring we should do in versus external debt restructuring we should do. And then there are options in terms of the perimeter, which things we should have brought in, which type of debt we should have brought into the basket of what we're looking at, and then which type of creditors we should have looked in there. There were options there, but my answer was debt restructuring or not debt restructuring. So there are nuances over there. Philip, over to you.
Thank you, Prof.
Don't envy you at all.
Thank you, Philip. Maybe just before you come in, Philip, we have posted in the chat a link for feedback. That feedback will be very helpful to us in terms of how we improve upon this. Philip, I'm just trying to buy some time for you to reflect on this. So Philip, over to you.
I don't envy myself. So yeah, so Andrew asked a lot of questions. Let me try and answer them the way I understood the questions. The first one is on the overdraft extended to government. And if I heard Andrew right, Andrew was asking how this figure that was done in 2022 compares with that of 2021. If you look at 2021, the overdraft was zero. In fact, if you go back in history since 2015, 2016, that overdraft figure has always been zero. And then it bumped up to this level in 2022 because of the crisis and because of the institutional view, the position that the central bank took to deal with maturing instruments. The central bank took that view to pay all maturing trades to allow economic activity go on. So we took that decision as a central bank to pay, and that is what has resulted in this large overdraft. So in simple terms, last year in 2021, the overdraft figure was zero, and now it's 39 billion for 2022. But again, to put it in context, you know, the year 2021 was the year just after COVID. And in the COVID period, we saw the crisis that happened. We saw how the central bank intervened. And then we quickly went to zero financing in 2021 because the COVID was over. There was no crisis. 2021 was a period that the economy was beginning to restore and refix itself. And then we jumped on into 2022 with all this crisis on our necks, and which necessitated the financing. His second issue, I really did not understand that question too much, but I heard him talk about interest rate, comparing interest rate with something. We can get back to that issue, but I think on the third issue, he was asking about expenditure component in all of this. And if I understood him right, he's saying that having gone through all this process, if we don't touch the expenditure component of government's fiscal operations, that component could rise very quickly and then consume all the gains that have been made. I think he's right. And he's asking what I expect in terms of a cut in expenditure. I think this conversation is now already in the public domain, and we are beginning to talk about it. The Ministry of Finance itself made some expenditure cuts in the 2022 budget, 2023 budget for this year. But I think the issue now that is arising is whether those expenditures are enough. And of course, then the question then goes to whether there is even scope to even cut back on more expenditures, given the rigidities that we have in the budget. But I think it's a good thing this issue is now in the public domain following the domestic debt exchange exercise. I think we need to talk seriously about the expenditure. Government will have to open up the expenditure for everybody to see what really goes on in there as far as the expenditures are concerned. When that is done and more transparency is shed on the expenditure side, I think things will become clear to people. But that is in the public domain. It is being discussed, and I think at the appropriate time, solutions will come. Thank you very much, Andrew. Andrew, I don't know whether you want me to go on to some of the questions that you really asked.
Yes.
Yes, the first question.
Yes.
Yes, the first question is that some banks may go under, and what do I have to say to that? I think we see this narrative in the media. We see this narrative in the media because, like any responsible institution, we will have to conduct a stress test analysis on the banking system. The Bank of Ghana has conducted a stress test analysis on the banking system, and that is why the Bank of Ghana has unleashed all these liquidity regulatory reliefs to the banking sector, quote unquote, to try and make them stand to the impact of the domestic debt exchange exercise. And as to whether the banks are going to go under, I think the banks have always been very strong. Of course, when there's a shock to any system, there are weaknesses. And of course, some of the banks will be weak. Some of the banks are weak. They need support. And that is why we've put in place all these buffers. So we've put in place the liquidity component. The solvency component is also being dealt with in the form of the Financial Sector Stability Fund. And with these two together, I think the banks are in a better position to continue to deliver what they are delivering to the public. So as to whether the banks are going to go under, I really don't see that from where I sit at the moment. And I think the banks will come out better and in a much good position after the exercise. There was a question on the time frame for macroeconomic stability. And the time frame for macroeconomic stability, I think that time frame will come immediately after the domestic debt exchange program is done. But let us also not forget that we've opted as a country to go for an IMF program. That IMF program is running for a period of 3 years. It is going to stretch from 2023 all the way through to 2026, 2027, thereabout, by which time, if you look at all the indicators would have moved to very sustainable levels. We expect inflation to decelerate back to within band. We expect growth to also move steadily after 2023 back to its long-term trend of around 5.5 to 6%. We expect reserves to be built up strongly over the course of the period. And then all in all, our current account balances will move into healthy territories. The fiscal deficit, we expect the fiscal deficit to come down significantly. And when that comes down significantly, we expect government's demand for resources to go down. It will help push down interest rates. So we expect interest rates to move quickly within the teens, the lower end of the teens at the end of the program. So give or take, by the time the program ends, we'll see a healthy consolidation of all the key macroeconomic indicators. The third question that was asked me was on the Russia-Ukraine war. This gentleman wanted me to educate him on what the war did to the economy. So in answering this question, I'll refer back to my initial opening comments. And you recall in my initial opening comments when I was talking about the issue on inflation, I did talk about the fact that there were so many driving factors that impacted on inflation in the course of last year, 2022. I rightly started with the Russian-Ukraine war, the global food prices, the US monetary policy, and the stronger dollar, and I touched on fiscal dominance issues. So the Russia-Ukraine war is part of the factors that contributed to our inflation moving from 13 to 54% by the end of the year. Now, what did the Russian-Ukraine war do? Well, see, the Russian-Ukraine war significantly helped push crude oil prices from where we were before the war at around $70 or $80 per barrel to over $120 per US dollars. That jump alone in the crude oil prices coming from the Russian-Ukraine war filtered through to our domestic economy. Look at the number of times that we increased crude oil prices in last year. This was heavy noise to the consumer basket. It was heavy noise to the consumer basket, and it did push inflation up. So inflation gone up, crude oil prices gone up, domestic petroleum prices up, transportation prices did move up. It affected food prices again. So it affected food prices on top of the world food prices, which were increasing. Many people are not aware of the importance of Ukraine in the global trade business. They produce a lot of cooking oil in Ukraine, and a lot of cereals and grains also come from Ukraine, and it affected the World Food Price Index. Look at crude oil. If you look at the consumer basket that the Statistical Service collect on a monthly basis, and you look at how cooking oil, the price of cooking oil jumped up in the course of last year, it was very significant. Then in the basket, that also impacted on prepared food that we have in the consumer basket. It also jumped up significantly. So, well, you might not see the Russia-Ukraine war itself, but it's because of the geographic importance of Ukraine. It did cause a lot of havoc to specific commodities. We being an importer to some of these commodities got impacted. Let us not forget that Ukraine also produces a lot of steel. And if you look at the price of steel in our consumer basket, so almost all building projects, building products in the consumer basket, if you checked, they did move up significantly last year because there was war between Russia and Ukraine. It pushed up steel prices. It pushed up oil prices. It pushed up cooking oil prices. It did push up prices of cereals. All these things have filtered through our domestic inflation basket and contributed to the inflation. I hope I've touched on that. I think the last question was what you expect to be cut. Oh, that is the expended. No, I've already dealt with that. And I think the next question was the next step after the domestic debt exchange program. If the IMF bailout does not work, what do we do? I think this is the question. I think the IMF bailout program should work for us. I think we are headed in that direction. We will need that for some calm. The Prof did talk about the patient. We need to stabilize the patient at this stage. The IMF program will definitely have to work for us, and we need to work hard to ensure that we go through all the prior actions that have been set out in that program to ensure that we get the program as quickly as possible. And I think on that basis, I've addressed 4 or 5 questions. Mr. Moderator, I think I'll yield at this stage.
Sure. Thank you. I think you have answered the questions. We have quite a number of other questions that have come through. I see a hand up, but I'll come to you shortly. I think Yao, your hand is up, but I'll come to you shortly. I'll just read a few more questions, and then you reflect on them as we take those questions. But the question I have is again to flip, enlighten us on the lessons learned by Bank of Ghana to also ensure fiscal discipline in the system and be stronger in its relationship with government. That's what government's Bank of Ghana's control and strength in relationship with government in ensuring discipline on the fiscal side. Then there's a question which is related, that Bank of Ghana, there are 2 institutions, Bank of Ghana and Ministry of Finance. And so the economic challenges that have been created by the institutions that mobilize and spend money. If Bank of Ghana does not have control over government spending, don't you as a relationship between Ministry of Finance and Bank of Ghana? There's a question also here that says, do we have strong institutions to drive the Ghanaian economy devoid of political and toxic relationships? And that's a question, do we really have strong institutions to drive the Ghanaian economy devoid of political and toxic relationship? I don't know who will take that, but we'll come back to that. The last question here, as I see it, is how are the banks being supported to restore their financial value and IFRS shareholders' expectations and capital restitution? How are being supported to restore their financial value, IFRS 9 compliance, shareholders' expectations, and capital restitution? Prof, I'll come to you on that last question. And also, maybe if you can use the opportunity to highlight what are the accounting implications for how we treat some of these government securities in this particular time as well. Now, I'm conscious that we've run out of time. So we crave your indulgence to spend maybe 15 more minutes on this call. So please, if you keep it short for us. Philip, do you want to go first? And I'll give the opportunity to Yao to ask the last question.
Okay, so I'll take it first. The line kept dropping as you were reading the questions, so I missed some of them. But I think this is what I got. The lessons learned by Bank of Ghana.
Should I just quickly recap? Okay.
No, I think I got the lessons learned by Bank of Ghana to ensure fiscal discipline, our relationship with government.
Yep.
Then there was another one we talked about the Bank of Ghana and MOF relationship. I think I'll answer these two questions in the context of fiscal monetary policy coordination. And the issue is whether there is fiscal monetary policy coordination between the Bank of Ghana and the Ministry of Finance, because we need the fiscal to be well coordinated with the monetary to deliver a certain outcome for the economy. And I think that coordination exists. It exists through many platforms. There are regular meetings held between the bank and the ministry where we see red flags. We raise these red flags to the Ministry of Finance. They come, we talk, we discuss the issues. There are also letters flying around indicating where the pressure points are likely to come from in the future. So they need to take cognizance of all these in what they do. So yes, there is. But I think the big thing which we tried to do, I think way back in 2013 or so, when we had another IMF program, I think that IMF program wanted to lock in fiscal discipline by setting the central bank financing to zero. And I think when that issue was taken to Parliament, it could not pass in Parliament at the time, and Parliament refused to grant the zero financing to the central bank. They voted against it on both sides of the aisle at the time. I remember, and the cure that was found for this was to have a memorandum of understanding on zero financing. So the legislature did not pass the zero financing, and I think at the time the explanation the legislature gave was that they wanted to align the zero financing with what existed with other sister central banks in the region, in the context of the West African Monetary Zone Convergence Criteria, where almost all the central banks had that clause in their law, which set the financing limit to 10% of the previous year's revenue. So at the time, what our legislature did at the time was to say, okay, we will make ours a little bit tighter and move from 10 to 5%. So instead of granting zero, they set an upper limit of 5% of previous year's revenue. I mean, one can argue that that limit of 5% of previous year's revenue includes a zero financing figure. But I think beyond that, what people are looking for is to really lock in a zero financing and ensure that the issue of fiscal dominance and fiscal discipline does not come in to wreck central banks' operations and to have undue pressure on inflation. So it is something that we are looking forward to in the future. And we hope in the future the legislature will move to pass a law that ensures zero financing of the budget. Now, I think this is what I gathered from the questions that you asked. Unless I'm missing something, you might want to repeat. You might want to repeat because there was a question that I missed actually. But we can always do this in the context of after the program. We can respond to some of these questions individually to those who are asking the questions.
Thank you, Philip. I think in the interest of time, you've kind of answered. My apologies if something hasn't been answered. But Prof, do you want to come in? But before you do, actually, Philip, I know you talked about a law for zero financing that they didn't pass, but we are aware of the Fiscal Responsibility Act 2018, which actually places some limitations on what we can do on the fiscal side and what we can't do. So the question is whether really is an issue of lack of laws or it's more an issue of discipline and lack of fiscal rectitude. That's not a question you should answer. But Prof, you want to speak to the issue of accounting implications, compliance, what is being done to support banks, what the IFRS side may look like as well. And then Andrew will have, sorry, Yao will have the last comment. Please ask your question now. Yao, please, over to you.
Thank you. Thank you very much, Mr. Jato. Thank you very much. My question is in connection with the earlier question I asked about the Russia-Ukraine. When Dr.
So if we keep it short for us, that will be very helpful.
Okay. When Doctor was making his submission, Dr. Philip was making his submission, he made mention about, crude price going up. And if crude price went up, I would say that we are also producers of crude, so it's near to our benefit. Then secondly, Russia embassy in Ghana, warned Ghana about twice to stop using Russia-Ukraine war as a result of, the mess in which we are. And thirdly, when we look at what we import from Russia and Ukraine, it's not even, up to 1%. So if you can throw more light on that. Thank you.
Okay, Philip, whilst you reflect on that, Prof, can you hear me clearly? Is Prof back? Okay, so whilst we wait for Prof, Philip, please, over to you if you want to respond. And I think you may want to also tie that to, I think this question has been actually answered in terms of what banks, how are being supported to restore financial value. I think you touched on central bank reliefs and regulatory reforms to stop. But I think there's something on but if you want to respond to Yao's question as well, that will be very helpful. Thanks.
Question, thank you very much. Yao's question, still on the Russian-Ukraine war, is on, I think the first one, he's saying that Ghana, we both import and export crude oil. And therefore, he thinks that the impact on the economy should be zero. There should be a zero impact because while exporting and getting income, we are also importing. But this is the thing. When we import the crude oil, we are bringing in the product at a certain price. and that price is passed on to consumers and the rest of the economy. This is different in the case of Nigeria, where in Nigeria, the crude oil prices are heavily subsidized. So in our case, when we export, we also make income. Now, if that income that we were making was being used to subsidize the high crude oil price, then I think the net impact on the economy would have been zero. But the export income from crude oil also does something very different to the economy and has no bearing on the price at which these products are coming in. So these products are coming in, and by the nature of our crude oil pricing, it's passed on 100% to the rest of the economy, and that is how come it impacts on inflation. And again, it takes me back to the laws and the institutions. And if we had a law somewhere saying that all these gains made from crude oil prices should be used to offset crude oil prices in times like these, to ensure a net zero if impact on the economy, then it's a different story. But that is not the story. And I'm afraid the crude oil price increases that we saw elsewhere in the world, which filtered into domestic prices, were passed on 100% to the rest of the economy. And that is how come we saw transport traders were all clamoring for increases in transport fares. The government was hustling with them to lower the price. They were using moral suasion to try to get the transport owners not to fully pass on this to the rest of the economy. But we had an impact.
So Philip, I think that's about okay.
Okay.
You've responded. I don't want us to be logged out of this session because we've actually run out of time. And so I'll give you the opportunity to just your closing remarks and Prof as well. Please, you have maximum between the two of you.
Okay, I'll go first. I'll go first. I think I'll borrow from the words of the Prof. Can you hear me?
Yes, yes, we can hear you. I can hear you.
Okay, so I'll borrow from the words of Prof. And Prof said, what we are witnessing is a seismic event. So we are witnessing a seismic event, which is impacting all facets of the economy. But the economic managers are doing well to try to get us out of this situation. I'm confident that we will get out, just as the Prof also said, we will get out of this. But then I'll go back to my same old issue that beyond the debt exchange, we need to work hard, very, very hard, to ensure that we put in place all the necessary structures to forestall the reoccurrence of this event again in the next future. We don't need this. We need to go beyond this, and we need institutions properly set up to help deal with the recurrence of such an event in the future. I'll just urge all economic actors and players just to remain calm. I think work is being done to address the situation, although difficult, but I think in the end, we will come out of this. I think these are just the last closing comments that I have to say. Thank you very much.
Thank you so much, Philip. Prof, you have 1 minute to do this for us, please. If you can hear me, Prof, over to you.
Okay, can you hear me, Robert?
Yes,
can you hear me?
we can. Yes.
Okay, all right. Okay, so mainly I align with what Philip has said. I think we have to learn lessons from this. But the first thing I would say is that we have to, particularly policymakers, but also academics in the area, ought to study what has happened and learn the lessons from it and feed it into the national policy dialogue. Again, I come to, do we have a comprehensive view of what happened? That's a descriptive. Are we trying to understand why it happened? And would we then move to what would happen if we did nothing else? And then do we have policy prescriptions to address what would happen in future? I think these are very key things. Let me just also say that insofar as banks are concerned, the exposure to the issue of IFRS 9, banks need support both from the regulatory breathing space that they are being given, but also for the liquidity support that is needed for them to move over. Let me just say a final word on the Russia-Ukraine stuff. You see, what happened with that is that it moved inflation across the world to a high level. And because we import a lot from other countries who are suffering from inflation, our input factors from the import end became laden with inflation from other places. So whereas there might not be a huge direct inflationary impact upon us, apart from the oil issues, there are other factor inputs inflation that we're looking at. So our inflation wasn't only demand side inflation, it was also heavily supply side inflation, which is what we need to address. But a word to the policy makers. The IMF program will provide us some breathing space, but we need to go to address the fundamental structural issues of our economy. And it takes political boldness. I come back to what is our national development narrative. If we don't have one, then we've got to start building one that unites us around a purpose, and then execution become key to our success as a nation. Thank you very much for those of you who have been on board, and let the conversation continue. Let your voices be heard. Thank you, Robert.
So thank you, Prof. And thank you, Philip, for your closing comments. We've learned a lot, which is our mandate, the educational side, and we have quite some significant number of people who join us. Our apologies to those who couldn't join on Zoom, but we made other provisions, and others took advantage of that. Baromis, please complete the feedback form that we shared a link with you. Please complete that for us. That would definitely help us improve upon what we've achieved today. The collaboration between the Chartered Institute of Bankers Ghana and certainly the National Banking College will continue, and I'm sure Gloria will talk about that in her closing comments. And so that's where I hand over to Gloria. I think I don't need to rehash some of the things that have been said, so I'll just humbly hand over to Gloria. Gloria, over to you.
Thank you. Whew, what a lovely 2 hours it has been. We could have gone on and on and on and on. To our panelists, you know already, thank you so much. Philip, you've stayed up late to do this. Thank you so much. Prof, it's been phenomenal. We've had a great time. This first collaboration has just been so beautiful. Like Robert said, we apologize for the limitation on the Zoom link, but all other channels, we also saw very active involvement, and we are most grateful. We will not finish, this is just the beginning, and we will come back with more topical issues. And we know that anytime we call on our panelists, they will be available, and we will continue to help build our industry, to bring understanding to our people, and to find ways and means of making our lives better. Thank you all to the people who work behind the scenes to make this happen. And we will look forward to working with all of you again. Please fill up the comments sheet as has been sent to us, and let's know what you want to know, and we will come back with it. For the National Banking College and the Chartered Institute of Bankers, we say God bless us all, and may our country and our nation grow stronger and better. Thank you very much. And please have a lovely day. God bless us all.
Thank you.
Thank you.